Is Disney undervalued? Hello, everybody. Welcome to the DIS Stock Analysis. This is StockerFinance. I'm your host, David Scheuer. Make sure to follow me on Twitter at StockerFinance for more information. So recently, Walt Disney is currently trading at $122.35 a share with a decent dividend of 1.44% yield annually, with a market cap of around $221 billion. And you'll notice that there's no PE ratio on this little summary here. And that's because Disney, well, it's taken a pretty big hit in the current situation. And if we go ahead and look at the one-year chart here, you can tell that it took about a 38% dip back in February and March. It has since recovered a decent amount, about 42%, but not fully recovered yet. On top of that, over the past 5 years, it's actually had a pretty poor performance, only up about 22% over the past 5 years, significantly less than the performance of the S&P 500 and the Dow Jones, as well as most indexes out there. It's performed pretty badly. However, if we go to the max chart here, we look about more like 10 years ago, from 2009 to 2015, it went on a surge, about an annual gain of 100% over that 6-year time period. So an incredible surge in price there. And part of that was because the 2008 financial crisis hit. It bottomed out pretty significantly there. However, even after that, when it recovered, it still went on a massive surge. And I beg to ask the question, are we due for another one of these surge in prices, in its share price for Walt Disney? Is the company's performance going to take off soon? Are we due for another surge like this, or is it going to continue on with kind of a poor return over time? Now, the thing is, I think Disney Plus is going to drive all of this. I think Disney Plus is genius, and I think Disney is due for another massive surge and for some actual great returns year over year. I think it's currently undervalued, and I think Disney Plus as a whole is a genius idea for Disney, and I'm going to tell you why. I'm going to go through the summary in this video, in this Disney analysis. We're also going to touch on some other topics as well for my reasoning. Now, the first thing is Disney Plus is genius, as I said. It's realized how to further the profit from movie releases. So basically, for Netflix, what they have to do is they have to buy the licensing for movies, or they have to go and pay actors, get producers, investment, whatever it might be, to create a movie. And it can cost millions of dollars. They spent, hundreds of millions of dollars creating just a single film and then put on their website, which people are already paying monthly for. So the cost per user or per subscriber is significant. I think it was something like $70 or something like that. And if you know how much a monthly subscription is for Netflix, it's like $14. It can take a while before they actually that movie or whatever they made actually pays for itself. That's a huge problem with Netflix, but Disney is on the other end of the spectrum. Although it's spending a ton of money right now on Disney Plus for marketing, getting it out there, trying to gain subscribers, get momentum going, creating a couple original shows like The Mandalorian, it still just basically plasters a MP4 of its movies that it already owns. So it's not paying for all that licensing, all that other stuff. Most of its movies are already made, and on top of that, when it makes a movie, it can release it in theaters as it did before, make a bunch of money, become a profitable film from the theaters, and then plaster it on for Disney Plus for even further profit and to give its subscribers there more content, basically for free on Disney's part, which is pretty incredible. So the next thing here that we're going to look at is the cost per user, as I said, which is significantly lower than Netflix. It also it supports regular broadcasting television with streaming. So the regular television, I think it's kind of slowly fading away. However, the streaming segment of it is really interesting. As you can see with Hulu Plus and Hulu Live, that subscription allows you to watch live sports, watch things that you would usually only be able to get with like a cable package, basically. On top of that, they're strategically releasing content. So they release Hamilton. The biggest fear I had with Disney Plus is that everyone's going to watch The Mandalorian, like just binge through it, and then it was going to die off. However, they were very strategic. Number one, they only released a Mandalorian show about every week, so people stayed for at least a month or two to watch that whole season, since it was, really good show, extremely hyped up. I think it was one of the key successes to Disney Plus as of right now. And then it kind of died off for a little bit. I didn't really know that many people that were, going and buying Disney Plus, although I knew a lot of people who still had it. And then they released Hamilton, which, if you haven't watched the Hamilton plays, it's super popular, especially with girls, I've noticed, and with just a lot of people in general, a lot of young people as well. And so that play, they released it on there, and tons of people watched the musical. Then they're releasing a new Mandalorian series, a season 2 to it, which is coming out in October, I believe, so fairly soon. And that's going to get everybody back engaged. And so now if you're considering canceling your Disney Plus for whatever reason to save money, or if you're trying to choose between Disney Plus and Netflix, well, maybe you're going to choose Disney Plus now because you want to wait for the Mandalorian series to come out. So I think the Disney Plus releases, also the Clone Wars release was perfectly timed as well. It's been perfectly timed, great execution there, and they're really providing competition to Netflix with these strategic releases. If we look at Disney Plus total subscribers here, you can tell it's done on a surge as they've released in multiple countries, approaching 60 million. It's actually already past 60 million. If we compare this to Netflix, it's closer to 200 million, but still, Netflix has been around for years. I mean, a long time now, which Disney Plus has not been around for nearly as long of a time. But if Disney Plus continues gaining at the current momentum and this growth that it's experiencing with its streaming membership, if it just keeps adding, keeps marketing and investing money, and you can see by the amount of cash, we're going to look at just how much cash Disney has in a second here. Well, it's got an immense amount of cash that it's able to put to use right now. And if it puts a lot of that to marketing and spending on Disney Plus, it's going to benefit them significantly in the long run. And I think Disney Plus will really come out to not only bring them back to where they were, pre this pandemic situation. I'm not supposed to say that word because it might get demonetized. But anyways, besides that, though, I think it's actually going to bring them above and beyond where they were, because Netflix is a $200 billion company. If Disney Plus has, it almost has nearly half the subscribers and the memberships that Netflix has. And most likely in a few quarters or within, I think, in my opinion, within a year, it'll have at least 100 million streaming subscribers. And although they pay the revenue per user might be slightly less than Netflix, if we take the same valuation as Netflix for the streaming service, that means Disney Plus could hypothetically be valued at around $100 billion. Now, Disney is currently valued its market cap at $200 billion. That's a 50% increase in market cap just on one segment of Disney, which is super interesting to think about. But again, that's kind of a hypothetical situation. The valuations for these companies are incredibly different, especially when it comes to just like the PE ratio, the demand for the stock, etc. But if we go ahead and look at a more detailed version, you can tell that Disney Plus has been growing significantly in its amount of users, and it's actually reached 60.5 million subscribers, which is pretty fantastic. And I suspect it's going to be much more going into winter when people are, it's cold outside, people are at home with their families. It's winter break for college students, high school students, etc. They're going to want to get Disney Plus, watch The Mandalorian, watch these shows again. I expect that to increase pretty dramatically in the coming months. Now, if we go ahead and look at the revenue, this is revenue per user below on average, monthly revenue per paid user. And above that is the subscribers breaking down not just Disney Plus, but all their different streaming platforms, which is really interesting. And so if we combine all those, if we combine ESPN Plus, all the Hulu, which includes live TV, Hulu, and Disney Plus, what combines to 104.5 million, actually a little more than half of the total subscribers that Netflix has. Now, Netflix is valued over 200 billion, and if we take that valuation and we do it in terms of the number of subscribers, well, then Disney Plus could hypothetically again be valued at $100 billion, which is insane. However, the paid per user thing is where it gets a little tricky here. So Netflix, the cost per user is significantly more than Disney Plus's. However, they charge a lot more. Disney Plus has released a lot of deals, which has brought down the revenue per paid subscriber. You can see that ESPN Plus decreased from $5.33 to $4.18. Disney Plus is at $4.62. However, their live TV is at $68.11, and they're about 3.4 million users using that service there, which is pretty incredible. And here's some reasons for why the prices are what they are right now. So the average monthly revenue paid per subscriber for ESPN Plus decreased from $5.33 to $4.18 due to the introduction of bundle subscription package of Disney Plus, and Hulu, which was in the beginning of 2019, kind of right when Disney Plus released. And this lowered the per subscriber advertising revenue. However, the bundle offering has a lower retail price than the aggregate standalone retail prices of the individual services. But they did this to attract and market to more users. It was a great deal. I think tons of people got this deal, and I think it was very strategic on their part, but it did cost them a little bit of revenue there, since the revenue of this bundle together is less than individually for these services. The average monthly revenue per paid subscriber for the Hulu SVOD only service decreased from $12.68 to $11.39 due to lower per subscriber advertising revenue. The average monthly revenue per paid subscriber for the Hulu Live TV plus SVOD service increased from $58.42 to $68.11 due to increases in retail pricing and live TV per subscriber advertising revenue, partially offset by the introduction of the bundle subscription package. So we saw a pretty significant increase of about $10 there, which is pretty great, especially since that's their most expensive option, which again has about 3.2 million subscribers there. So this is a very profitable segment, or at least it will be in the future, although they're spending a lot of money on advertising, creating a little bit of content as well. I think they're going to spend a lot of money in the near future, but in the far future, it's going to become an extremely profitable segment for Disney that will benefit them greatly, support all their, their normal cable and their live TV with ESPN, everything else going on, A&E as well. So they're going to support all that revenue. And honestly, I think this is going to be a huge portion of Disney in the far future that will be a very strong competitor with Netflix. If we look at revenue segments here, you can tell there's a significant drop in revenue in Q3. And that's obviously because of the current situation that we're in. The parks are all closed. People were locked in. That's why we saw a huge increase in the amount of subscribers. But in terms of total revenue, especially with parks, experiences, and consumer products, it decreased to an abysmal amount right there. As you can see, it's highlighted in red. Media networks has stayed pretty even. Same with studio entertainment, decreased a little bit, and direct to consumer international, it's about the same as well. But as you can tell, when Disney Plus was introduced, it had a huge spike in how much revenue they were doing there, and I expect that to grow significantly. Now, let's say that parks returned to past revenue. Well, I did a little graph here of what it would look like. As you can tell, it would look more like what it was back in Q2 and Q4 of 2019. Now, that's pretty interesting because if we take that valuation, well, Disney was trading at about $151.48 then, significantly above what it's trading at now. So if we pretend that Disney Plus has surged, or if we know that Disney Plus is going to do really well in the future, and then we say, okay, well, what about when all the parks are open and Disney's kind of back to normal? We just take that normal revenue, the pre-COVID revenue there, we combine it all to get a kind of intrinsic value for revenue, and it looks like the graph right here that I showed you, plus maybe even a little higher than that if Disney Plus revenue is greater than that by then. And that means it hypothetically could be trading at $151.48 pre-COVID revenue. Now, that's really hard to value there. It's a little tricky, but that's just kind of a situation to show that Disney Plus is most likely currently undervalued when we look at the intrinsic value and intrinsic revenue in the far future when things return back to normal. So now let's talk about this revenue, and it breaks it down in their quarterly earnings release, and this was back in June, by the way. So some of this information is a little bit outdated now, but it is the most detailed information we can get from Disney as of right now. So broadcasting revenues for the quarter increased 12% to $2.5 billion. Operating income increased 55% to $477 million. The increase in operating income was due to lower network programming and production costs, an increase in affiliate revenue due to higher rates, higher program sales, and lower marketing costs. These increases were partially offset by lower advertising revenue. The decrease in network programming and production costs was due to production shutdowns as a result of the current situation, driven by The Bachelorette, American Idol, Grey's Anatomy. The increase in program sales income was driven by the sales of The Simpsons, Modern Family, and The Politician, partially offset by higher program and production costs due to a timing impact from new accounting guidance. Lower advertising revenue reflected a decrease at the owned television stations and lower average network viewerships. And this is no surprise to anyone. Everyone kind of expected this. Tons of different things got shut down. Whole movie productions were not allowed to keep going. Advertisers weren't advertising as much. This isn't much of a surprise to anybody, but now that so many more people are watching TV, I think a lot of this advertising revenue has returned significantly. A lot of these programs are back up and running. And I think this has kind of changed or turned around since June 30th, since we've had a bit of a change in the situation since then, although not too much of one. Studio entertainment. So studio entertainment revenues for the quarter decreased 55% to $1.7 billion. Segment operating income decreased 16% to $668 million. The decrease in operating income was due to lower theatrical distribution results, partially offset by growth from TV distribution, a decrease in home entertainment marketing costs, and lower film cost impairment. Sorry, I'm stumbling over my words. Just a lot to read here. Theatrical distribution in the quarter was negatively impacted by COVID-19 as theaters were generally closed domestically and internationally. No significant titles were released in the current quarter compared to release of Avengers Endgame, Aladdin, and Dark Phoenix in the prior year quarter. And you know what? I think once people start going back to theaters and theaters open up again, which it could be a long time from now, who knows when that's going to happen. Again, we can go back to the slide that we were looking at before with this. If parks returned to past revenue, we can also add in theaters there. And I think it's going to return significantly to that, which means if we return to the price that it was during that quarter, $151.48, significantly above what Disney is currently trading at now. Now, if we go ahead and look at revenue and operating income, pretty steady. Operating income plummeted pretty sadly there. Net income actually went negative just due to the whole situation. I don't think this is much of a surprise to anybody. This looks pretty devastating if you've never really followed Disney or, analyze stocks too much, but a lot of investors expected this to happen, and the hope is that this coming quarter, when they release results here, will be significantly better than this, that they'll either break even or be making a profit again. That's my hope for this. As long as this decrease in net income starts going back to normal again, we see a trend towards positive income and hopefully a return to the normal net income that we were doing, which was about $2 billion in net income or more there. I think that'll happen. I just don't know when, since the parks are still, there's a lot of situations going on. We have seen some parks open up, some theaters start to go back to normal again. And we've also seen Disney Plus start to take off more and more. I think once Disney Plus becomes profitable, once they start slowing down their marketing spending, film creation spending, etc., it's become a very high margin business. Again, with releasing films into the theaters, making money off that film there, then plastering it on Disney Plus, so everyone goes home and wants to watch it on Disney Plus, or if they don't want to go to the theaters, they watch it there. They're going to make a lot of money. I think it's going to be a very high margin business for Disney Plus, especially significantly higher margin than Netflix, who spends a ton of money per user to create all that content. Now, if we look at their margins, no surprise, it plummeted pretty out of control here. That's just due to the current situation. Operating expenses actually didn't decrease as much as I thought they would with all the parks being closed, but I guess maybe some operating expenses increased with television stations, something like that. I'm not sure exactly the details there. Growth went negative as well, no surprise there. But the amount of cash they have on hand is actually pretty absurd here. About nearly $25 billion just of cash on hand for Disney there. And if we look at free cash flow, it increased significantly from, if we look at 9 months ended June 29th, 2019, $699 million in cash to now over $2.6 billion in free cash flow. So cash provided by operations for the first 9 months of fiscal 2020 increased by $1.7 billion from $4.3 billion in the prior year 9 months to $5.9 billion in the current 9 months. The increase in cash provided by operations was due to lower income tax payments and higher collection of accounts receivable, partially offset by lower segment operating results and increased spending on film and television productions. The decrease in income tax payments was due to the prior year payment of approximately $5.5 billion of tax obligations that arose from the spinoff of Fox Corporation in connection with the TFCF acquisition. Now, that was just a little summary of why it increased there, but the amount of free cash flow increase here is just completely absurd and a really positive thing for Disney there, especially with the cash on hand. And one thing that just shows that you'll see in a second here is that they really are able to survive the situation and ultimately come out significantly on top after we start to recover back to normal again with their parks opening, etc. Now let's look at their assets and liabilities. They have about $207 billion in total assets, with about $41 billion in current assets. And their total liabilities are about $117 billion, which have increased pretty substantially, not just recently as of this quarter, but over the past few quarters as well, due to increased spending, taking on a little bit more debt as well. There's a lot of going on there. If we look at the net current asset value per share, what we can do is we take the total assets. It's a little different than how Benjamin Graham did it back in the day. He did actually current assets minus total liabilities, but we're not going for a liquidation company here. This is Disney overall, so I'm going to use the total assets because I also want to include property, a bunch of other stuff as well. And we're going to subtract total liabilities from that. Gives us $90 billion in shareholder equity, which is very, very positive for Disney, which has a market cap of around $200 billion. So $90 billion in shareholders equity is about half of that, which is pretty incredible. If we divide that by the number of shares, which is about 1.8 billion total outstanding shares, we get a value of 49 cents on $86 per share. Now that is our net current asset value per share, also known as a liquidation value to some people. That's significantly less than $122 per share, which is currently trading at. But even though it's less, it's expected, and it's a very healthy ratio, which is the difference of about 83.95%. It's nothing to worry about here, and the fact that they have nearly half, they're a little less than half their market cap in shareholders equity is pretty incredible there. And a lot of that has to do with the amount of cash on hand as well as the value of their property. So now let's talk about what's called the current ratio. And I threw up the definition here in case you don't know what it is. So a creditor would consider a high current ratio to be better than a low current ratio. A high current ratio indicates that a company is more likely to pay the creditor back. If current liabilities exceed current assets, the current ratio will be less than 1. So from the math we just did, we know current ratio is not going to be less than 1. It's going to be fairly good. And if we look at the current ratio, it's about 1.34 with current liabilities at 38.92 and current assets at 41.33 billion. So that's a really good sign that Disney's debt is not a significant problem, despite it being significantly higher than what it has previously been in the past. So let's do a little analysis of the Magic Kingdom here. Well, the long-term intrinsic value exceeds current share price, which I think just by looking at Disney Plus, looking at what the revenue was pre-COVID and what it might be once it returns back to normal, once all the parks open up, theaters start going back as well. And then we include the increase in revenue from Disney Plus, from some TV stations, and from people's habits of watching more television, watching more entertainment as well. The long-term intrinsic value definitely exceeds the current share price. Disney Plus will drive Disney stock and the company to new heights. I think that's just a really significant portion of this company in the future. I think Disney Plus will drive this company significantly. I think it's going to be a very profitable segment of Disney, especially once theaters return and people start going and watching the movie in theaters, and they plaster that onto Disney Plus some original shows to get people hooked and get new subscribers. I mean, they're still releasing in so many new countries, still marketing to people. I think Disney Plus is going to grow significantly. Along with that, you also have Hulu, ESPN, ESPN Plus, and live TV on Hulu as well, which are generating tons of new subscribers and earning lots of revenue there as well. Disney is also adapting significantly. I think Disney Plus shows that Disney is not just an old company anymore. It is adapting and changing. We see the strategic releases of different films onto Disney Plus. We see different TV shows. We see really unique things going on with ESPN and how they're handling sports. So I can definitely tell that Disney is adapting, even if it's not necessarily Disney, if it's its subsidiaries doing that. You can tell that the whole company is a very adaptive company, which is good to see, even though they're facing a lot of challenges right now. Some short-term problems with the parks. Theaters are still a little sketchy. Some people are saying that people never really return to theaters. That'll never have the same prime that it had in the past. We never really know when sports are going to get fully back on and going again, although it does seem like it's trending in a very positive direction. The NBA handled the whole situation very well. I actually really enjoyed watching the games in the bubble there. So some short-term problems, but they seem to be slowly getting better and better over time. On top of this, people are getting hooked on TV and entertainment, and habits are very hard to break. I think people are going to have a lot of bad habits from this whole situation. I think there's going to be a lot more TV watching on average overall, a lot more entertainment watching, since people are going to be so sucked in to their TV and to entertainment. On top of that, people are going to, once the parks open up, people are going to want to get outside, go with their families, go on vacation. And I think once the parks open up, it's going to be a surge of people going there, and that'll be no surprise. We've kind of already seen that a little bit at some of the parks. So people are getting hooked on TV, and habits are hard to break. On top of that, the net current asset value per share is less than the current share price, which could be a negative, but because the ratio is pretty positive, on top of that, the current ratio is very great, showing that their debt is not a huge problem, even though it's increased compared to previous years. The past few quarters, it's increased pretty significantly due to increased spending, as well as some deals they've been making, some acquisitions as well. Parks and entertainment revenue plus more Disney revenue equals awesome, or Disney Plus revenue equals awesome. No surprise there. On top of that, their shareholders' equity is approximately half of their market cap right now, which is a very good thing to see. The fact that after you subtract all your liabilities, the amount of assets you have is half of your market cap. That's a pretty good ratio. Most companies, it's significantly less than that right now, especially when looking at a lot of the tech companies. Their assets are very abysmal compared to their insane market cap. So this is a very solid company there when it comes to looking at its assets, its ratios, and a lot of the different debt to equity ratios as well. Anyways, guys, thanks for watching. Please subscribe. I know this video has gone on for a little bit here. Check out these videos as well. Make sure to follow me on Twitter at StockerFinance, and I'll see you guys in the next video. Peace out.